Hello everybody and welcome to my monthly Vietnam update. September was a relatively quiet month in terms of liquidity and performance, with the VN index increasing slightly by 1.5% in US dollar terms. Meanwhile, the AFC Vietnam Fund, impacted by the insurance sector, dropped by 0.7% according to internal estimates. Hi, my name is Andreas Vogelsanger. I'm the CEO of the AFC Vietnam Fund. Don't forget to subscribe to our YouTube channel in order not to miss any updates. Thank you. In September 2024, the Vietnamese stock market was notably impacted by Typhoon Yagi, one of the most severe natural disasters to hit northern Vietnam. The typhoon, which struck during the first week, caused widespread devastation, claiming more than 300 lives, with floodings and landslides impacting over 70,000 homes, particularly in the northern mountainous area regions. And major areas like Hanoi, Quang Ninh, home to the UNESCO heritage site Ha Long Bay, and Haiphong, Vietnam's largest seaport, were impacted by the typhoon. The devastation prompted the nation to shift its effort towards providing aid and relief to the affected storm victims. In alignment with this national response, the AFC Vietnam Fund also donated to support the victims of the disaster, reinforcing its commitment to both the community and the country during this challenging time. As a result of this typhoon, the stock market dropped by over 2% in the first half of the month, but managed to recover and close at 1,352.56 points, marking a gain of 1.5% in US dollar terms. While the broader market rebounded in the latter half of the month, the insurance sector did not recover as quickly. The sector was significantly affected by the typhoon, with PVH, the largest insurer, dropping by 5.8%, PVI sliding 6.1%, MIG losing over 10%, BIC tumbling by 4%, and ABI, one of our largest positions, plunging by 6.2%. Given that the insurance sector accounts for around 7% of the AFC Vietnam Fund's portfolio, the storm's impact weighed heavily on the fund's performance. According to Deputy Minister of Agriculture and Rural Development, Nguyen Hoan Yep, the total economic damage from Typhoon Yagi could reach around 2.5 billion US dollar, a figure 5 times higher than the total damage caused by natural disasters in 2023, and exceeding the combined toll of the past 3 years. The losses are expected to reduce GDP growth by 0.15%, bringing it below the prior forecast of 6.8 to 7%. Localities such as Haiphong, Quang Ninh, Thai Nguyen, and Lao Cai could see their growth rates drop by more than 0.5%. Despite this, the Vietnamese government remains committed to its initial GDP growth target of 6.8 to 7%, which surpasses the 6 to 6.5% forecast from the National Assembly and predictions from international institutions such as the IMF, World Bank, and ADB. Given this confidence, we believe that Vietnam can still achieve an impressive GDP growth in 2024, despite the significant impact of Typhoon Yagi. In the second half of September, 2 significant developments positively influenced the Vietnamese stock market, creating strong momentum for long-term performance over the next 2 to 3 years. The introduction of the non-pre-funding circular and the anticipated Fed rate cut. These factors are expected to be key drivers for sustained market growth. On 18th of December 2024, the Ministry of Finance issued a circular providing pre-funding solutions guidelines for the securities brokers, custodian banks, and investors. This regulation set to take effect on the 2nd of November 2024, represents a significant step towards improving the efficiency of Vietnam's securities market. Once implemented, FTSE will allow its clients 3 to 6 months to test the system and offer feedback. Based on this timeline, we anticipate FTSE could announce Vietnam's upgrade to emerging market status during either its March 2025 or September 2025 semi-annual market review. According to estimates from Morgan Stanley, Vietnam's upgrade to emerging market status could result in billions of US dollars flowing into the market, creating substantial positive impact on the stock market. What many had anticipated finally happened on the 18th of September 2024, when the Federal Reserve, or short Fed, announced a 50 basis points rate cut, the first since 2020. Fed Chairman Jerome Powell also signaled potential further reductions, with another 50 basis points expected at the end of 2024, followed by 100 basis points in 2025, and an additional 50 basis points in 2026, bringing the key rate to 2.75 to 3% by 2026. This decision is a positive catalyst for emerging markets like Vietnam, with wide-reaching benefits across both the stock market and the broader economy. Here are some of the key impacts. Support for global consumption and investments. Over the past 2 years, the high interest rate environment has dampened global consumption and investment, especially in the US, Vietnam's largest export market, accounting for over 33% of total export turnover. Vietnam's export to the US were particularly affected by the rate hike in 2022 and 2023, but began to recover in September 2023. With the Fed rate cut, we expect a stronger resurgence in Vietnamese exports to the US, alongside more stable growth in the coming years. Lower interest rates will also encourage global firms to increase investments in Vietnam, boosting foreign direct investments, or short FDI, inflows. Easing of monetary policies. Many countries have been reluctant to loosen monetary policy due to the US high interest rates. In Vietnam, the State Bank of Vietnam attempted to reduce rates to a 4-year low, but the widening interest rate gap between the US dollar and VND, or Vietnamese dong, drove the exchange rate to an all-time high in July 2024, limiting further cuts. With the Fed rate cut, central banks around the globe, including the SBV, or the State Bank of Vietnam, can now feel more confident about easing their monetary policies to stimulate growth without worrying about excess pressure on exchange rates. Reduction in FX stress. The Fed's previous high interest rate policy strengthening the US dollar, leading to a surge in the US dollar value against most currency, including the VND. This caused a significant pressure on foreign exchange rates globally. With the Fed now cutting rates, this stress is expected to ease, allowing central banks to apply more accommodative monetary policy without the same level of currency devaluation concerns. Decreased sovereign debt burdens. Higher interest rates increase borrowing costs, putting a strain on countries with significant sovereign debt. For Vietnam, the Fed rate cut will alleviate some of the burdens, making it easier for the government to borrow at more favorable terms and manage its debt more efficiently. Boost to investment sentiment. Rising Fed rates over the past few years led to significant outflows from the Vietnamese stock market, with foreign investors withdrawing over $2 billion during the first 8 months of 2024. This exodus negatively impacted local investor sentiment, causing the benchmark VN index to fluctuate between 1,200 and 1,300 points, without a breakout. We believe the recent Fed rate cut will restore positive investment sentiment, spurring foreign investment inflows and encouraging local investors. Vietnam's strong economic growth could propel the VN index to new highs and in the coming years. Well, this was all from me. Thank you very much for listening, and you're gonna hear from me again next month with another update. Thank you and goodbye.